Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Hi, everybody, and welcome to the March 21st edition of Macro Minutes called Humpty Dumpty. I'm Jason Daw, your host for today's call, which we're recording at 9 a.m. Eastern Time on March the 21st. So it might be an overly simplistic argument, but in hindsight, it should not be surprising that aggressive Fed rate hikes have broke something in financial markets, and policy actions to ring-fence the problems have been fast and furious. But the question is, can all the king's horses and all the king's men put dislocated markets back together again? So on today's call, we're going to discuss the current situation for European and U.S. credit, macro, and monetary policy. So we're joined today by Nicola Dransfield in our European financial credit strategy team, Adam Jones in U.S. credit trading, Tom Porcelli in U.S. economics, Blake Gwinn in U.S. rates, Peter Schaffrik in U.K. and Europe macro and rates, and Adam Cole on currencies. So to kick off today's discussion, I'm going to talk about some high-level points on macro and policy. The first one is that policy actions are working to some extent, and I think the good news is that financial stability concerns have been limited to certain areas such as bank credit, government bonds, and bank equity, and the contagion to other asset classes has been pretty limited. The bad news, in my opinion, is that the bounce that we've seen in dislocated assets has been pretty small so far relative to the aggressive policy actions taken so far. And I think the longer the markets, fail to mostly recover the moves since March 8th, the more worried we should be. I would say one item to watch is the news today that the U.S. is exploring ways to guarantee all deposits in the regional banking system, and this would surely be a game changer given, one of the big underlying risks for financial stability right now is deposit outflows. On my second point, the economic damage, is real. So smaller banks in the U.S., they have been an important contributor to bank lending, outpacing that of larger banks the last few years, and especially in areas like commercial real estate, which was already in a bit of a vulnerable position. So with lending standards already tightening significantly, this is a new downside risk to economic activity. But I would say, though, with everything going on in the U.S., the situation in Canada has been calmer by comparison. Bank stocks, they have been dragged down by the U.S., but they have significantly outperformed their U.S. peers. And at the end of the day, Canadian banking does not face the same problems as the U.S. Banking sector. Now, even with the new downside economic risks probably emanating from the U.S., the chance of near-term rate cuts in Canada, so the market's pricing these by July, seem quite low. At the end of the day, macro simply doesn't support it, and for rate cuts to be justified, I think would require the worst-case scenario for financial stability unfolding. So there's probably value there in fading tail risk scenario rate cut pricing. And the last point I want to make is that a lot of the move in fixed income has probably been due to positioning. We saw record shorts in U.S. futures, and those collided with one of the biggest rallies that we've seen in the bond market on record. Now, in Canada, 10-year yields are about 25 basis points too low based on market pricing for the terminal rate and rate cuts. So while we've been bullish on duration in 2023, there is little value in being long at these levels, and risk-reward probably favors paying for a bounce. So now on to the fun stuff. Next up is Nicola, who will tell us what's happening in the European financials credit space.
Yeah, hi everyone. I just wanted to talk through real quickly about what happened with Credit Suisse and kind of where we've ended up. The starting point here, I think what we need to remember is that Credit Suisse was a highly problematic bank to begin with. The group was in the middle of a restructuring. There were already a lot of questions going around whether they'd be able to execute this successfully while remaining a viable operator. On top of that, there were issues at the bank around risk controls. as well as outstanding litigation cases. Now, if we take a step back and we think about the year so far, before SVB or any sort of issues at U.S. regional banks, investors were very positive on European banks, and a number of them were overweight in the space. And, this really made sense to us because we're finally getting rate hikes in Europe, and broadly speaking, bank balance sheets are in a good place. Unfortunately, when SVB happened, the sentiment towards banks changed pretty quickly, and people started looking for the next cracks in the system, and that's when we saw Credit Suisse emerge as the weakest link, and concerns regarding their viability as a bank ramped up very aggressively. So over sort of the last week or so, things deteriorated rapidly. The Swiss regulators eventually stepped in, and over the weekend they brokered a deal whereby UBS, a much more solid Swiss bank, would buy Credit Suisse. Now, this deal with UBS, it really should have been a positive because it removed a lot of the contagion risks and fears that Credit Suisse introduced. Remember, this is a globally sort of systemic bank here. However, in order to facilitate the deal, the regulators decided that Credit Suisse AT1s, so their most junior subordinated bonds, would effectively be zeroed. Now, this caused a significantly negative reaction in the AT1 market at large, and I'd say really across financial credit more broadly. Why? Two things. So firstly, this is the largest AT1 write-off that we've ever seen, plus it happened in such a large systemic bank, really a key bank globally. Secondly, and more importantly, AT1 holders got zero. So debt holders got zero, but Credit Suisse shareholders were still getting something. They were going to get UBS shares. And this is just simply not how the creditor hierarchy should work. What we then saw, as yesterday progressed, was other bank regulators coming out with statements, specifically the Bank of England and the EBA, and they were saying that this is really a uniquely Swiss outcome, and if they were in any similar situation, they would look to respect the hierarchy such that AT1s would only absorb losses once equity has been wiped off. Effectively, they were trying to stop the read across to all AT1s at large. Ultimately, this did help the AT1 market somewhat as the day progressed. We did see some of the initial declines reversing somewhat. And then just to give you a sense of the spread moves that we saw in Credit Suisse itself, if I just take a simple Euro senior bond in the longer end, there we saw spreads move from about 400 basis points to a peak of just over 800 basis points. As of today, we've retraced back most of that, and we're actually now tighter on the month as Credit Suisse's spreads converge towards the much more solid UBS's. So I think at the end of the day, we've avoided the catastrophe of Credit Suisse going under. The tone in bank credit is somewhat better today, but I think, ultimately the cost of issuing these AT1 instruments after the situation is definitely higher, and I'd say risk premium in funds more broadly certainly has increased for the time being. So I'll finish up there and hand it back to Jason.
Okay, thank you very much. Now over to Adam Jones on our U.S. credit trading desk to discuss the situation from his lens.
Yeah, I mean, this morning's probably the first time we've had a chance to breathe for about a week. Obviously, the trouble in the banks has ripped through credit markets, catching everybody a bit flat-footed. We saw substantial widening, as you would expect, in bonds and in hedge instruments. IG hit wides, CDX IG hit wides of 94 basis points, but it's rallied into 80 this morning. So the last day or two has seen a significant improvement in sentiment. But obviously, front and center has been the regional banks. Nobody's been wanting to touch that paper. We've seen material selling across accounts, as you would expect. I think the biggest surprise, though, has been how that has fed through very quickly to broader credit and indeed curves. We've seen significant pressure at the front end. My favorite proxy for front end is SPSB, which is a front end ETF, and the spread on that has moved from 67 basis points a couple of weeks ago to 150 basis points. If you compare that with LQD, which is more like a 10-year benchmark, that moved from 155 to 190. So, there's a difference between a 35 bip move and, almost 100 basis points. You can also see the extent of the selling and sentiment change in the floating rate market. FLRN is probably the best ETF to look for that, and that just has completely fallen out of bed, which is a mixture of lack of liquidity, ETFs leading the charge, and just a general aversion to notional at risk. So where do we go from here? This morning has definitely been an improvement in sentiment. I think for us to have any meaningful rally, we're going to have to see curves normalize, though. This damage at the front end has to be reversed. These front end funding spreads pretty much can't remain at these levels. And I think that as far as where I expect to see changes, that's going to be one of the first things that has to start to come back down. But obviously the fear is still there. The regional banks have scared everybody. People are starting to look at balance sheets, which is always a bit scary when it comes to financials. And we're getting lots of questions about hold-to-maturity portfolios, about commercial real estate exposure. And the truth is, when you start to peel back the onion on these banks, there are issues there, and typically a bank could be allowed to earn its way out, but right now it feels like people aren't giving it the time that's needed, and so there's certainly a tension on whether the FDIC do indeed extend insurance on deposits beyond 250K to just make larger depositors feel comfortable at these regional banks. And in the background, the longer play is, credit conditions are materially tighter because of this. We would expect a decrease in lending, and then ultimately, does that guarantee a recession? But that's a somewhat slower moving animal, and given the severe move we had in spreads, it's not surprising to see a bit of a bounce.
Okay, great. Thanks a lot, Adam. So Fed pricing, it's, bounced around over the past week or so between 50 and 80%. Now it's closer to 80% going into tomorrow's Fed meeting, and Bloomberg consensus, seems to be in the camp of a 25 basis point hike. So, now over to Tom for his take on the Fed this week.
Look, I think that the Fed is going to hike rates tomorrow. As we wrote last week in the Daily Desk, it was going to be a game-time decision basically based on how things evolved over the last week. And right now, things have evolved in such a way that the Fed will likely feel comfortable hiking tomorrow. So they go 25. We don't think that they're supposed to go 25, but we've also been saying that now for the last few meetings. The Fed is still fighting yesterday's war on inflation, and it just goes to, again, it just drives home how dreadful they think the inflation outcome is, that they are willing to hike rates in the midst of bank stress. That just strikes me as off base and slightly tone deaf, but it's their ball game. So all in the context of what the Fed should do versus what they will do. Look, I think the biggest thing that we're worried about, and again we mentioned this last week in a daily or two. Look, lending standards were already on the rise. We've been fond of saying for months at this point that if you look at just the sort of, like a 4-quarter delta, point-to-point change in lending standards, this is the biggest increase since the GFC, if you exclude the pandemic. And so what do you think is going to happen to lending standards going forward? This is going to be a challenge in that, and we sent this note out or had a chart yesterday, just to a few folks, just to take a peek at, just so they can understand this idea that we've been talking about, which is to say, if you look at the thing that has been the key driver from a spending perspective, it's obviously first and foremost it has been the drawdown in saving. The drawdown in saving is starting to sort of normalize here a bit now, stabilize is probably a better way of phrasing it. And so what's picked up the baton? Well, credit. And we can easily see a scenario where on the back of all this happening, that really starts to fade. So, if there's an irony, and I'm not even sure if irony is the right word, but if you consider Q1 growth is going to look pretty good. You're probably looking at around 3% growth. I think Q2 growth will look a little softer, but it'll still be pretty decent. I think the second half of the year, though, is going to look very different. And I think that therein lies the challenge for this Fed. So market pricing of cuts, I think, again, anyone who reads our research well knows that we've been saying that for quite some time, that they would cut a couple of times in the second half of the year. We feel even more emboldened in that view than ever. That's it for me.
Okay, great. Thanks a lot, Tom, for the insights. Next up is Blake to tell us where maybe the Fed might surprise us tomorrow, or any other thoughts on the U.S. bond market.
Yeah, thanks, Jason. And I have to say right up front, I mean, I think, as you were kind of describing the price action, we're almost underselling it to a degree. I mean, since the last time we had this call 2 weeks ago, Fed pricing for year-end 2023 has been trading in a 220 basis point range, which is absolutely mind-melting. We've had the markets focus whipsaw from 2 weeks ago when they were focused on, some still kind of resilient economic data, and we were starting to hear more chatter around the possibility of returning to 50 basis point hikes, to the point where we now have some of the major banks out there calling for cuts at this meeting, and at least a decent contingent kind of seeing a likelihood for a pause at this meeting. So really a shocking kind of turn of events, particularly for something as short as 2 weeks. This has come both, this price action has come both via falling terminal pricing. We've seen that move from around 570 level all the way down to kind of 490. We've seen expectations for the start of the cutting cycle, as you mentioned, pulling forward. That had been in around January 2024. 2 weeks ago, that has pulled all the way into having the first full cut around July 2023. I think it's important to note that a lot of this price action, a lot of these issues around the banking sector really only started to heat up after the Fed was entering into the black period, which is important because it's basically left us with virtually no guidance as to how the Fed is kind of weighing recent economic data, kind of their base case as it existed 2 weeks ago, against these kind of potential systemic risks, all of this instability, uncertainty, and the likely kind of medium to longer term impacts that this banking sector stress is going to have on financial conditions. We just really don't know how the Fed is looking at these things. But in our view, I do see a decent possibility that we basically come out of this Fed meeting with the Fed essentially looking tone deaf to markets. I think with only kind of 2 weeks, with only 2 weeks of this, I think it's unlikely the Fed's majorly kind of recalibrated a lot of their models. I think they are going to come out and express confidence that the actions they've taken on the liquidity side have, kind of effectively stemmed some of the broader risk around these financial stresses, and try to separate out rate policy from financial stability, and say, look, the toolkit we have for financial stability is these liquidity facilities and actions, and rate, the setting of rate policy is entirely dependent on kind of, the inflation goal and kind of macroeconomic policy. If they do that, I think that's probably going to come as a disappointment to markets, who I think are hoping for a bit more reaction from the Fed to these recent stresses. So in that event, I mean, I think we probably see what's been a fairly classic reaction to hawkish Fed surprises, where the front end starts to price the Fed essentially putting on blinders and trying to hike their way through this, but at the same time seeing some of those probabilities of cuts later on exaggerate. And I also think that given how many kind of stop outs and how much pain there's been in the kind of fast money sector over the last 2 weeks, I think some of the people who would normally be playing around in some of this front end Fed pricing are on the sidelines, and what that means is that if we do get this kind of hawkish interpretation, a broader kind of risk-off move could be the bigger driver of rates, and any kind of duration bid on that risk-off flow could serve to push some of that cut pricing below levels that even we, as Tom mentioned, we've long expected cuts, but push it to levels that even we see is probably somewhat extreme. It's just very difficult to position for those views now, because you're basically taking an implicit bet that there's not another shoe to drop in the banking sector, that things are going to essentially calm down, and that that the cut pricing that we've seen enter into 2023 is going to reverse. So I will pause there and pass it along.
Okay, great. Thanks a lot, Blake. Now over to Peter to weigh in on the situation in Europe.
Yeah, good morning to everyone in North America. Good afternoon to everyone in Europe. So what I thought I'd do was, first of all, I'll try to look back a little bit, because we obviously had a bit of a sneak preview how central banks might react last week when we had the ECB meeting. Take a look forward to the Bank of England meeting, and then make a more general comment about my view on the situation over here. So first of all, when you look back, what did the ECB do? Well, they did hike rates by 50 basis points, actually, as they had indicated previously that they would. but they also refrain from giving any further strong guidance going forward. And I think how we can interpret that is they look at the inflation fighting part of their mandate, saying, well, the situation has not sufficiently changed. We need to deliver that, and they have. But we don't really know how the situation will continue in the future. We feel less confident about giving strong guidance as we did before. So they basically left all options on the table. They could hike further, they could stop hiking, and they could do something entirely different. What they've also done, however, is they stress that the European banking system as a whole is significantly more stable, and particularly as the Credit Suisse situation was unfolding, and as the U.S. situation was unfolding, they stressed that they see they think there's a significant difference to the European system, which is well capitalized, much less leverage, and typically quite well oversight. Now, what they've done, though, is that if push comes to shove, we have a significant amount of tools at our disposal to address the situation, reading liquidity injections, TLTRO, these type of things. And so far, that seems to have worked, and particularly, as Nicola mentioned earlier, since the clarification that the capital stack, the margin order would be upheld in Europe, the market has calmed down. So is that a blueprint for particularly the Bank of England? We think it could be. Again, we don't have the same kind of situation in the UK banking system either. And the Bank of England has been less committing to forthcoming action compared to the ECB anyway. So we expect actually that they will hike 25 basis points, mainly justifying that with the inflation fight, and will then continue to keep all options open. We actually think that because the rates are already higher and the economy is probably a bit poorer, is performing a bit poorer than say the U.S. economy, and they probably already will bring their rate hiking to a close. It's not entirely clear, of course, and the market has a small probability of them going further, but we think that 425 is where they're going to stop. Just as Blake was saying for the U.S., the market's already pricing cuts. It's pricing cuts in both markets, and we think that's very unlikely to be delivered. So last but not least, what's my take on the entire situation? Well, clearly, as Nicola was saying, the Credit Suisse situation has been fairly unique. Could there be any other unknowns in the European markets? Of course. But also keep in mind in Europe, and the continent of Europe in particular, rates are significantly lower compared to where they are in the US particularly because the ECB started later. So that whilst there is a feed-through, obviously, of the higher rates, is not to the same degree. And secondly, the liquidity provisions are significantly higher at this stage because no real purposeful QT has yet started. So I actually think that here in Europe there's quite a few opportunities after the market dislocations that we've seen. Just to name a few, I think, for instance, if you just look at how, be that sovereign credit, be that sub-sovereign credit, be that credit in general has performed, there's probably opportunities here against the Government market. I also think that there are, in the implied rate path, that there are opportunities now. When you look, for instance, where the market is pricing ECB rates by December 23, is not much higher than where it is now, after pricing a hike to 325 and then implying cuts again. I think there's a good opportunity here to pay or to sell Euribor futures, for instance, and that's probably going to drag the outright level along. So I think the market's probably rallied a bit too much over here, and I'll probably be leaning towards a slight short position. And also, if you're so inclined, implied volatility in the rates market has shot up, implied 3-month, 10-year, 3-month, 2-year implied swaption vols have back at the peak where we've seen them in 2022. And I think there's good opportunities there where you could start being short volatility again. And with that, I'll leave it and hand it back to Jason.
Okay, thanks a lot, Peter. Last but not least, Adam Cole on the currency market, where the dollar has been unusually stable during this period of turmoil.
Absolutely. Thanks, Jason. So, indeed, for all of the volatility and moves in other markets, to look at the FX market through the dollar index, you'd think it had all completely passed us by. compared to the just before the SVB event, dollar index is down about 1% or so, and it's traded up 1% and down 1% in a very tight range. It's not the case, I think, however, that this has passed us by, but what we have seen is something of a regime shift in the way FX trades. From prior to the SVB event, and we've talked many times about this before, bonds and equity markets moving in the same direction typically for the last year or so. What this has done is take us right back into the world that existed before that period, that people call row, risk on, risk off. We call it the world of one trade, but where bonds and equities move in opposite directions, and FX trades in line with currencies, status as RICS proxies or safe havens. And the dollar is kind of caught in the middle in that kind of environment. Dollar doesn't comfortably fit into the risky bucket or the safe bucket. And what we tend to see, and what we have seen over this period, is therefore FX markets that are dominated by movements in the safe currencies, Swiss franc and the yen, and the risky currencies at the other extreme, the commodity currencies and the Scandis primarily. And that's really what's dominated. Going forwards, I think the risk is that we stay in this kind of environment while the uncertainty overhangs, and that the dollar, again, is trapped in the middle. And we are in markets that are a lot less what I would call dollar directional than they have been for the last year, and play out more through this risk-on, risk-off theme. As far as generating ideas is concerned, I think we have to go back to applying a discipline that we applied prior to the last year or so of price action, which is being very focused on relative value. So looking where possible to express macro ideas in currency pairs that are not correlated or lightly correlated to swings in broad risk appetite, so as to take a cleaner view on macro themes. And that's indeed exactly what we're doing in terms of our short-term idea generation. Ultimately, if asset markets do stabilize, we can go back to thinking about dislocation in terms of monetary policy and relative rate movements, relative cyclical positions, etc. But at least for the near term, I think the discipline is being aware of those asset correlations that are freshly re-emerging, and setting our trades up to take account of that. Finally, I would just say again on this context of shifts in dollar directionality and diminishing dollar directionality, we wrote about this in the latest edition of our weekly Total FX, looking at ways you can express that shift in dollar directionality through vol or implied correlation in options markets. And with that, back to Jason.
Okay, so thank you for joining this edition of Macro Minutes. The narrative in financial markets has pivoted from one extreme, that everything is okay and significantly more hikes are in the pipeline, to the other extreme, that rate cuts are forthcoming soon. And in reality, the answer probably lies somewhere in the middle. So stay tuned to our publications or reach out to us directly in the interim for additional insights on what we're thinking.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.